I would expect either one, earnings to come back up around 15 billion, or two, market multiple, and two, market multiple to come back down on those earnings. That's going to limit the potential of the return on the investment. So I think that's a big cautionary tale here. Let's take a look at free cash flow. Right, that's the real heart of the matter here. How do you value business? It's on the free cash flow. 2015, they had 10.5 billion of free cash flow. You'll notice this number is extremely close to the EBITDA. You would think there'd be a bit better of a gap there. Generally, you have taxes, some working capital changes, some other cash expenses that come out between EBITDA level and cash flow from operations. Interest expense would be one of those, plus taxes. But these numbers are surprisingly similar. I'm not a huge fan of that. There's probably could be a growing tax liability that's not being paired. And then look at this. So this is really 2015, 2016, $10 billion. And then free cash flow from operations declines in 17, 18, and 19, the years 2017, 18, 19, down to 9.4 billion. At the same time, you can see EBITDA growing from 10.7 billion to 12.5 billion. We don't like that. I don't like to see cash flow from operations going the wrong way from EBITDA. On a company like PepsiCo, that's a little odd to me. You can see then it reverts back up in 2020. They must have sold through a bunch of inventory or something like that, because cash flow went up in 2020. You would have thought it would be the opposite. EBITDA's flat, cash flow goes up, and then cash flow moves from 10 billion in 2020, 11, 10.5, 13, and 12, kind of bumping around. But that's a 2% growth rate over the long term. That's following the 2% EBITDA growth rate over the time. So I don't think there's anything funny going on here. It's just a little odd, a little commentary of cash flow didn't really follow EBITDA like I'd like it to see it every year. And I think the cash flow from operations number by itself is just too close to the EBITDA number. There should be some interest expense out of there. There should be taxes that are being paid in cash. There should be a bigger gap between those two. Just a smell check for me.